Okay, let's look at the last year, 2019. We'll walk through the assumptions and then go to the work page for that. Again, many of them similar to the previous 2 years. Our annual service cost for 2019 is $29,000. Our settlement rate continues to be 7%. A new assumption we're asserting in here, and that is the expected earnings rate. What we're going to do is assume that the plan assets will have an earnings of 7%, a return on the investment, if you will. I'll walk through in a few minutes what we do with that. The actual return for 2019 was $28,000. We contributed $32,000 during the year. We paid out $20,000. We amortized another $21,000 related to that $42,000 in prior service costs from the previous year. Then a new assumption. We have changes in actuarial assumptions that determine that our projected benefit obligation at the end of the year should be $640,000. So in other words, there may have been changes in present value, in life expectancy, any of the time to retirement, any of the factors that the actuaries incorporate into the calculation. They run through what they think it should be, and they think it should be $640,000. What that means is when we get down to the end of our pension worksheet, that's where our projected benefit obligation needs to be, or we will need to make an adjustment. So let's go to the worksheet. Balance at 12/31/18, those are the balances, the pension liability that is on our books, the projected benefit obligation and plan assets that are on the books of the plan. Those balances are just carried forward from the previous year. Looking at annual pension expense, the service cost was $29,000 from our assumptions, and we recognize that that would have increased the projected benefit obligation. The interest cost was $40,239. That's just the beginning PBO times the 7%. And again, we recognize that that would increase the projected benefit obligation as well. We had actual return of $28,000. That came from our assumptions, and that reduces our pension expense, and we recognize that that would have increased the plan assets. Now, here's where that expected return comes into play. So in an effort to reduce volatility running through the income statement, FASB says, recognize as your return on your investment an expected amount, and then you can adjust any gain or loss, i.e. difference between that expected return and the actual return at a later date. So our actual return was 28, which we acknowledge, but we had an expected return of 7%. So what we've done is I've taken 7% of the plan assets, subtracted out the actual return, and it looks like the expected return would have actually been $9,170 more. We can calculate that. You can see that here. The plan assets at 7% is actually $37,170. We only earned $28,000, which means we actually didn't earn as much as we thought, and so we had an unexpected loss, if you will, of $9,170. But notice the impact on annual pension expense. By doing this, we are actually reducing the pension expense by the full $37,170 that we expected to earn. This is where FASB is saying you don't have to recognize the volatility that might happen because gains and losses change from one year to the next. You can recognize what you expect to, but notice how it plays out. The plan assets go up only by the actual return. That is a done deal. They did not earn $37,170, they earned $28,000. The additional $9,170 that we're acknowledging in pension expense that we estimated, we're going to run through other comprehensive income. And then we will amortize it in the future. The amortization of prior service cost of $21,000 increases our pension expense just like it did last year. And we come down to total pension expense of $53,069. Our contributions, credit to cash, debit to the plan assets, benefits, just like always, only affect the plan. They reduce the projected benefit obligation and reduce the plan assets. Now, this liability increase. Remember in the assumptions, we said the actuaries did a calculation, and it looks like based on their calculations, our projected benefit obligation needs to be $640,000 at the end of the year. If you remove that $15,916, I'll get there in a minute, it looks like, in fact, our projected benefit obligation was only $624,084. So we're having to increase that projected benefit obligation by $15,916, the necessary amount to get it up to $640,000. Again, here's where FASB is saying you do not need to run that through income in the year in which it happens. We're going to put it through other comprehensive income. Notice it's a debit. It's going to be a loss because we actually had to increase our PBO. And then we will amortize it over future years, thereby not hitting a single year all at once. Now, here's what that gives us in terms of ending balances. Pension expense we already talked about. The credit to cash. We'll have a credit to other comprehensive income for the prior service cost amortization. And remember at the end of last year, we had a balance of $24,500. That will leave us with a balance at the end of 2019 of $3,500 yet to be amortized. New items in other comprehensive income. We have losses from two sources: the difference between expected return and actual return, and the adjustment to the liability for a total of $25,086. Both of these items run through other comprehensive income, but we're going to account for them differently because the calculation for amortization is different between the two. Then we're going to need credit to pension asset liability to make all of that balance. And with a credit of $43,845 at the beginning of the year, an additional credit of $25,155, that leaves us with a credit balance of $69,000. And here is where we can prove out whether that is appropriate. Remember, that amount needs to be equal to our over or underfunded status. In this situation, at the end of 12/31/19, we are underfunded by $69,000. We have a projected benefit obligation of $640,000, but our plan assets only equal $571. And so we'll come down here to our journal entry, a debit to pension expense of $53.69, a debit to OCI of $25.86, that's for the unrealized gains or losses, a credit to cash for $32, a credit to OCI for the $21,000 in amortization of prior service costs, and then finally a credit to our pension asset and liability account of $25,155. I think this takes us through all of the possibilities for a pension worksheet. What I am going to do in the next video is walk through how we calculate the amount that we can amortize for these OCI amounts.